Everyone is talking about the AI boom, and you've seen the headlines, the soaring stock prices, but what is it all actually built on? Today, we're going to look past all that and dig into the financial foundation, specifically the massive and often hidden debt that's fueling this entire revolution.
Yeah, the hype is everywhere, right? Incredible demos, stocks going to the moon. But as smart investors, we have to ask the tough questions. We need to look a little deeper. What's hiding just below the surface, on the balance sheets of the companies driving all this change?
And that's exactly what we're going to do in this explainer. We are pushing aside the stock valuations for a minute to look at something way more fundamental: the huge, complex web of debt and financial promises that are actually funding this whole AI gold rush.
All right, so our first stop is the infrastructure layer. We're talking about the physical stuff, the data centers, the chips, all the hardware that makes AI possible. And what we're seeing here, well, it's a massive gamble, and it's being funded by an absolutely eye-watering amount of debt. Just look at that number, $75 billion. I mean, let that sink in. In just the last 6 months, the big cloud providers, your Amazons, your Microsofts, took on that much new debt just for their AI project. To put that into perspective, that is more than double what the entire sector used to borrow in a whole year. The scale it's just staggering.
Now, not all debt is created equal, and this chart really shows you the story. You've got your usual suspects, Microsoft and Amazon, sitting in a pretty manageable range, and then you have Oracle. They are a complete outlier. They have cranked their debt-to-equity ratio up to a whopping 520%. That is an incredibly aggressive and, you have to say, high-risk bet to try and catch up in this AI race.
And here's where that high-risk strategy starts to bite. This table shows something called the interest coverage ratio. Basically, it's a measure of how easily you can pay the interest on your debt. It's your financial wiggle room. As you can see, Microsoft and Amazon are swimming in cash. They have huge cushions. But Oracle, their ratio is down at 5.1. That's what analysts would call stressed. It means they're walking a tightrope, with very little room for error if this massive AI bet doesn't pay off, and fast. But you know what? The debt you can see on the books is only part of the story. Things get really interesting when we start digging into the hidden risks, the murky world of off-balance sheet deals, especially for the companies that are actually building the AI models themselves.
And the key thing to understand here is something called a take-or-pay contract. See, companies like OpenAI or Anthropic, they don't own giant data centers. They rent computing power from the big guys. And they sign these ironclad long-term contracts that lock them into paying billions for that power, whether they use it or not. It's basically a massive future liability that acts just like debt, but you won't always find it on the balance sheet.
Now, this is where the plot really thickens, because it creates this weird loop of money going around in circles. A company like NVIDIA sells a ton of GPUs to a cloud provider. That cloud provider then uses these take-or-pay contracts as collateral to get financing, and then, get this, NVIDIA turns around and invests some of that money right back into the cloud provider. So you have to ask, is all this demand for AI hardware totally real, or is some of it just money chasing its own tail?
So for these AI platform companies, the big danger isn't traditional debt. It's what we call funding cliff risk. Think of them like a rocket that's burning fuel at an incredible rate to pay for those giant compute contracts. As long as the venture capital money keeps flowing, the rocket keeps flying. But if that funding suddenly dries up, they could fall out of the sky, and fast.
So, we have this whole system built on a mountain of debt and some pretty creative financing. It kind of feels like a house of cards, doesn't it? So what happens if someone pulls a card out from the bottom? Let's game out 3 high-risk scenarios that could shake up the entire market.
First up is what I call the productivity paradox. This is the dot-com bubble echo scenario. The tech is real, it's revolutionary, no doubt. But what if the actual business adoption, the real return on investment, is way, way slower than anyone expects?
The trigger here is pretty simple. It's when CFOs across the country start looking at their bills and say, hey, we just spent $1 billion on these fancy new AI chips, and they're only being used 10% of the time. Boom, the spending brakes get slammed on. The dominoes would fall fast. First, the chip stocks get hammered. Then the cloud giants are left holding the bag, facing massive write-downs on all that shiny, underused hardware.
Okay, our second scenario is much more sudden and much more severe. This is the regulatory hammer, a single catastrophic event that forces the government's hand.
Imagine you wake up one morning and the news is just everywhere. A rogue AI caused a flash crash in the stock market, or took down a power grid. You can bet governments won't just sit around and debate. They will act, and they will act fast with heavy regulations. The sky-high valuations of the big AI labs, they could collapse overnight. All that investment capital would flee from the pure innovators and rush toward companies that can prove their AI is safe, compliant, and regulated.
And our final scenario is a classic tale of tech disruption. It's the obsolescence shock. This is what happens when a new breakthrough makes all the current, super expensive infrastructure basically worthless.
So, what's the trigger? What if some brilliant engineer figures out a new way to run a powerful model on a regular laptop instead of $1 million server? The impact would be an earthquake. Trillions of dollars worth of data centers and GPUs would become stranded assets, basically giant expensive paperweights. The whole competitive landscape would flip. The advantage would shift away from big tech and go straight to the small, agile companies that can use this new, cheaper tech.
Okay, I know that all sounds pretty intense. So, does that mean you should just avoid AI altogether? No, absolutely not. It just means you have to be smart. You need to shift your focus from pure hype and speculation to a more defensive strategy that's grounded in the real world.
And here's a simple 3-step playbook to do just that. First, you've got to hedge against the pure hype. Second, invest in the companies that are adopting AI to get real results, not just the ones innovating. And third, focus on businesses that have structural advantages or moats that AI can't easily replicate.
So, what does this actually look like? It means being careful about going all in on hardware stocks that are priced for perfection. Instead, maybe look at an established company in a stable sector, like finance or healthcare, that's using AI to solve real problems and measurably boost their bottom line. And most importantly, always remember that the best long-term competitive advantages aren't the AI models themselves. It's the stuff an AI can't just create: proprietary data, huge distribution networks, and deep expertise in navigating complex regulations. Those are the real moats.
So, this really brings us to the final question every investor needs to be asking themselves. This AI boom is a modern-day gold rush, for sure. But history has taught us that when the dust settles, the biggest, most lasting fortunes aren't always made by the people selling the shovels. They're made by the people who use those tools to build something of durable, lasting value. So the question is, which one are you going to be?